to the fourth part of this chapter, the conceptual fixed asset system. Fixed assets are the property, plant, and equipment used in the operation of a business. These are relatively permanent items that often collectively represent the largest financial investment by the organization. Examples are land, buildings, furniture, machinery, and motor vehicles. A firm's fixed asset system processes transactions pertaining to the acquisition, maintenance, and disposal of its fixed assets. So, fixed assets refer to the tangible assets such as property, plant, and equipment that a business uses in its operations. These assets are long-term and essential for the business functioning, often representing a significant portion of its financial investment. Next, the specific objectives of the fixed assets systems are to, number one, process the acquisition of fixed assets as needed and in accordance with formal management approval and procedure. Processing the acquisition of fixed assets involves the steps taken by a business to obtain tangible assets like property, plant, and equipment necessary for its operations. This typically includes activities such as identifying the need for the asset, selecting suppliers, negotiating contracts, purchasing or leasing the assets, recording the transaction in accounting records, and placing the assets into service. It's a systematic process aimed at efficiently acquiring the resources needed for the business operations. Number two, maintain adequate accounting records of asset acquisition, cost, description, and physical location in the organization. Maintaining adequate accounting records of an asset acquisition involves accurately documenting the details of acquiring assets, including their cost, description, and physical location within the organization. This ensures transparency and accountability in the organization's financial reporting. By keeping thorough records, businesses can track the history and current status of their assets, comply with regulatory requirements, facilitate asset management decisions, and accurately report financial information to stakeholders. Number three, maintain accurate depreciation records for depreciable assets in accordance with the acceptable methods. Maintaining accurate depreciation records involves tracking the decrease in value of depreciable assets over time using acceptable depreciation methods as per accounting standards. This ensures that the reduction in value is properly reflected in the organization's financial statements, aiding in accurate financial reporting and decision making. Number four, provide management with information to help plan for future fixed asset investment. Providing management with information to plan for future fixed asset investments involves supplying data and analysis on the organization's current fixed assets, their condition, expected useful life, and upcoming needs. This enables management to make informed decisions about allocating resources for acquiring, maintaining, or disposing of fixed assets in line with the organization's strategic goals and financial capabilities. Number five, properly record the retirement and disposal of fixed assets. Properly recording the retirement and disposal of fixed assets involves accurately documenting the removal or sale of assets from the organization's books. This includes recording any gains or losses from the disposal, updating depreciation records, and ensuring compliance with accounting standards and regulatory requirements. It allows for transparent reporting of asset transactions and helps maintain the accuracy of the organization's financial records. Next, the fixed asset system shares some characteristics with the expenditure cycle presented in Chapter 5, but two important differences distinguish these systems. First, Managers in virtually all functional areas of the organization make capital investment in fixed assets, but these transactions occur with less regulatory than inventory acquisitions. This is because um, fixed asset transactions are unique. They require specific management approval and explicit authorization procedures. In contrast, organizations often automate the authorization procedures for routine acquisitions of inventories. Second difference between these systems is that organizations usually treat inventory acquisitions as an expense of the current period, while they capitalize fixed assets that yield benefits for multiple periods. This is because the productive life of a fixed asset extends beyond 1 year. Its acquisition cost is apportioned over its lifetime and depreciated in accordance with accounting conventions and statutory requirements. Therefore, fixed asset accounting systems include cost allocation and matching procedures that are not part of the routine expenditure systems. Next, the logic of a fixed asset system. The process involves three categories of tasks: asset acquisition, asset maintenance, and asset disposal. Next, here we go to asset acquisition. Asset acquisition usually begins with the departmental manager or the user recognizing the need to obtain a new asset or replace an existing one. Authorization and approval procedures over the transaction will depend on the asset's value. Department managers typically have authority to approve purchases below a certain materiality limit. Capital expenditures above the limit will require approval from the higher management levels. The process of asset acquisition within an organization, it begins with a department manager identifying the need for a new asset or replacement. The approval process depends on the asset's value, with lower value purchases approved by the department managers and higher value ones requiring approval from higher management. Once approved, the acquisition follows procedures similar to those in the expenditure cycle, with the asset being delivered directly to the user or the manager, and record keeping handled by the fixed asset department instead of inventory control. Next, asset maintenance. Asset maintenance involves adjusting the fixed asset subsidiary account balances as the assets, excluding land, depreciate over time or with usage. The method of depreciation and period use should reflect as closely as possible the asset's actual decline in utility to the firm. Accounting conventions and as possible the asset's actual decline in utility to the firm. Accounting conventions and IRS rules sometimes specify the depreciation method to be used. So, asset maintenance refers to the process of updating the balances of fixed asset subsidiary accounts as the assets depreciate over time with usage. Depreciation methods commonly used include straight line, sum of the year's digits, double declining balance, and units of production. The chosen method of a period should closely mirror the asset's actual decline in usefulness to the organization, sometimes guided by the accounting conventions and IRS rules. Next was this is the data flow diagram for fixed asset system. A data flow diagram for a fixed asset system illustrates how data moves within the system, showing processes, data stores, and data flows. It visually represents how information related to the fixed assets is captured, processed, stored, and distributed within the system. Next, we have the depreciation schedule. So, depreciation schedule This shows when and how much depreciation to record. It also shows when to stop taking depreciation on fully depreciated assets. This information in a management report is also useful for planning asset retirement and replacement. Asset maintenance also involves adjusting asset accounts to reflect the cost of physical improvements that increase the asset's value or extend its useful life, such as enhancement, which are themselves capital investments or processed as new asset acquisitions. Next, we have the asset disposal. Asset disposal, when an asset has reached the end of its useful life or when management decides to dispose of it, the asset must be removed from the fixed asset subsidiary ledger. The bottom left portion of figure 6 to 11 illustrates the asset disposal process. So, the process of disposing of an asset when it reaches the end of its useful life or when management decides to get rid of it. The process involves the responsible manager's suits issuing a disposal request, obtaining proper approval, and selecting one of several disposal options such as selling, scrapping, donating, or retiring the asset. A disposal report detailing the final disposition of the asset is then sent to the fixed asset accounting department for authorization to remove it from the ledger.